Listen-only mode.
Hello everyone, and welcome to this week's edition of our weekly coaching webinar for business credit. My name is Ty Crandall. I will be your host today. Today we are going to be going over a lot. I need to not even ramble here in the beginning and just get started because we have a ton of stuff to go over today. Today what we're going to look at is two very important things. First of all, before we get started, let me remind everybody we've got some great incentives for the month. Keep an eye on your email. I think I've already sent you one email. You're going to get another email shortly. Just a reminder of the incentives. If you have 3 sales this month, you're going to get some really cool free gifts. So just remember, it only takes 3 sales to get the free gifts. And if you're the biggest producer this month, you're going to get some really cool free gifts. Also, a lot of things will be happening here with these coaching webinars. Okay, right now I'm in the middle of running through to go through the finance products. What we're going to do is we're going to dedicate every week, we're going to dedicate to a different financial product until we make it through these financial products. Then we're going to be having people like Dex, our senior finance officer, come in, do a Q&A with us. We're going to have probably Megan Christensen come in, our senior business advisor. She'll be coming in. We're going to have some other special guests too. Okay, I just got an email from somebody that runs a very successful credit radio show, and he's probably going to come in and talk to us about what he does and how he does it and how you can duplicate success, and a lot of other things. So this year I've got a lot of good plans for some special guest speakers, and not as much just about me and content. Even have some of our biggest producers come on again and tell you about what they're doing, step by step, the kind of money they're making, all those type of things. Look, I talk about some of our top producers, and I request from you all that you don't reach out to these people. Look, I'll be honest with you, it bothers them. They're busy. It takes a lot to get to the point they are where they're producing a lot of sales. And, I hear from some of them that I mention their name in a webinar, and they're getting phone calls for people, and they're spending 5, 10, 20, 30 minutes talking to people about what they're doing instead of doing it. And that's really not fair or acceptable to them. So what I'm going to do is have some of these people come in. They'll be able to, again, walk through what they're doing step by step. You'll be able to learn from their experiences and also take a look back. We've already done at least a couple coaching webinars where we've had people come in and talk about what they were doing and the success they had, so there's a lot of great reference there also. That being said, I'm going to jump in today because we got a lot of stuff to cover. There's 2 main topics at hand. The first thing we're going to talk about, the second thing we're going to talk about, most important topic today is SBA loans. We're going to go through our full documentation products, okay? Because that's what a lot of clients come back to. Clients want full document pricing, or they ask about terms and rates, and they're kind of familiar, they're thinking about bank loans. So let's talk about them. We have them. We have the same SBA loan programs they're going to get at their conventional banks, so let's talk about those. Let's talk about the actual qualifications. We'll take a look at the SBA's actual qualifications. We're going to take a look at what the interest rates, what the fees are on these. We're going to take a look at these low interest products and these SBA-backed products and see how they work. You're going to know all the ins and outs. You're going to learn about the 2 different kind of SBA loans that are out there, what they are, how they work, who qualifies. But before we get into all that, we're going to start with the simple question. What is the interest rate? I hear this a lot from clients. Clients will come in and go, hey, Ty, look, I got this question. What's the interest rates? And I don't know how to answer the question. So what we're going to do today is we're going to start by answering that question. What is the interest rate? Okay? Because ultimately, this is something you're going to be asked a lot from customers. But please understand that everybody is just trained to ask this question, okay? That's it. It's simple. What's the interest rate? People are by, we're really just predispositioned and kind of almost trained to ask this question in our society, okay? But in reality, most people even don't know what the answer should be. So it's the first thing to know. When somebody's coming up and going, hey, man, what's the interest rates on these products? What do you say? That's always been a tough question for me to give you an answer to, because ultimately, what do I say? 90% of the programs we have aren't even based on interest. But the client doesn't want to hear that. The client wants to hear an answer. And here in a minute, a few slides, I'll tell you the exact answer to tell them. But the reality, the first thing you want to know when a customer asks you this question is they don't know what the answer should be. Think about it. Right now, what's a good interest rate on a home loan? How about a home equity line of credit? Or how about an auto loan? Okay, I can tell you that I spent a long time doing finance in the auto industry. I spent 8 years in the mortgage industry. I don't know. I have no idea. I do not know what a good going interest rate is on a mortgage right now or a car loan, probably because I'm not really looking for either right now. Now, if I was looking, I'd be able to rattle it off the top of my head. Most people on this call are the exact same way. You're asked these questions you don't know. The ones that said, boom, it's this, it's because you're looking right now. And so you're actively aware. It's in your awareness of what the rate is. But the truth is, most people don't know what a good rate should be. And I've learned this in my mortgage days all the time. You know, and my answer was always this was exact, because this question, no matter what kind of financing you're dealing with, is going to be asked. And with me, this is how it would go down. The customer would say, well, what's the interest rate? I would say, what's your credit score? What's your middle credit score? You see, I don't know. I'd say, I don't know. I mean, that was the conversation. And then I'd pause and explain it to them that risk is based on risk. If we don't know the risk, how are we supposed to know? So that was actually the conversation with the client. Well, what's the interest rate? Well, what's your middle credit score? Well, I don't know. Well, I don't know. Well, what I'm saying is, listen, I mean, it's based on your credit. It's based on the risk of the transaction. If you don't know that information and we don't know the risk of the transaction, then it's impossible for me to give you a rate. It made sense to the client. But it was always funny because it was always the exact same way. What's the rate? What's your middle credit score? I don't know. I don't know. And then I'd always let there be this awkward pause before I would explain it. Look, the bottom line is most people ask the question because they're trained to ask the question. They don't really know what the answer is supposed to be. Okay, you could tell them whatever, and they might say, well, it sounds good or sounds bad, but they don't even know what the interest rate's supposed to be. Now, what's a good interest rate on equipment purchase? Or how about a heavy equipment purchase? Or how about equipment lease back? Or how about a bank loan compared to an SBA loan? Or how about a merchant advance, revenue lending, film financing, securities loans? What are the going rates supposed to be? Do you think the client knows? I mean, most people on the call don't even know. Okay, so the bottom line is the first thing to know when somebody asks you what the interest rate is they're asking it because they're trained to ask the question. As a society, we always ask that question. The second thing to know is they have no clue what the right answer should be. They don't know what the interest rates and terms are supposed to be or what good interest rates and terms are on any of these products to begin with. So you have to be very careful of your answer because you're honestly being asked a loaded question. You're being asked a question that inevitably the client doesn't even know the answer to. They're just hoping you rattle off something that sounds good in their head. Okay, think about it. Makes a lot of sense. Okay, now that being said, again, I ask, what's the interest rate? The answer? Pretty simple. It doesn't matter. It doesn't matter what the interest rate is. Okay, what matters is how much a client saves and does the deal make sense. Now, again, I'm really going to teach you how to answer this question in a minute. But, ladies and gentlemen, this is what really matters. Clients ask the one question that ultimately doesn't really matter. Okay, what really does matter is this deal going to make sense for them? How much money are they going to save? Okay, that's what's more important than the interest rate. Let me give you an example. Okay, back in my day in the mortgage business, I'd save clients $1,000 a month to refinance. Okay, and I say this just to give you some sample numbers, but in a lot of cases, it was well more than $1,000 a month when they refinanced. Okay, they would consolidate and eliminate all their other debts outside of their home loan. Okay, then what I would do is I would introduce somebody to biweekly payments. Now, if you've never heard of biweekly payments before, biweekly payments is paying a $1,000 mortgage payment, but instead of paying it once a month for $1,000, you make 2 payments a month, one for $500 at one point in the month and one for $500 at the end of the month. If you're a math guy like I am, you've now realized that 500 plus 500 is exactly the same as the $1,000 payment they were paying, but by splitting the payment up, what happens is they beat the bank out of a lot of interest, and they'll reduce a 30-year loan to a 23-year payoff. So not only would I save these people a lot of money, what I would then do is reduce their loan payment to 23 years through biweekly payment. Now, in a lot of cases, they owed 28 years or so on their loan anyways. So I'm saving them $1,000 a month, and I'm showing them a way to come in and pay off their loan 5 years faster than they would have paid it off before they came to me anyways. Okay, that alone would save somebody $50,000, but who needs the $1,000 in savings, really? I mean, that was my thinking. I mean, they were living their lives without the $1,000, so let me help them spend the $1,000. So what I would do is show them how they could take half of that money, apply it back to their mortgage, and pay their mortgage down in 13 to 14 years. The person came to me with a 28-year mortgage. They left me saving $500 a month, and now I reduced their payment to or payoff to about 13 years. Okay, so let me ask you a question. What was the interest rate? It didn't matter. Okay, does it matter what the interest rate was? I mean, in reality, the interest rates at that time were 3 times what the interest rates are. 3 times. So if I went to somebody today and said I could do all this, but your interest rate's going to be 3 times what the going rate is, you think anybody would go for it? Probably not. But look at what happens. If you did the math on what I just showed you, this person saves over $258,000 in money they would save on that mortgage because of the reduction in years and the reduction of payment for the years they'll be paying. Over 250 grand. Save 500 bucks a month. Pay off their house in half the time. There's no way in this equation you could say it wouldn't make sense. And the interest is tax deductible. So it makes perfect sense. So what's the interest rate? That's the wrong question. You see, in this kind of case, if the person was only told the rate's 3 times what it is today, you think they'd go for it? No, they wouldn't. And they would lose all of the benefit because they were looking at the wrong piece of the equation. In the end, what really happens is it doesn't matter. What matters is, does the deal make sense to the client? Does it save them money? Okay, so let me give you a real business example from one of our clients. We had a company who won a contract to build a golf course. Okay, the company was paying a contractor about 20 grand a month to de-stump the golf course, to take all the stumps from the trees they cut down out of the golf course. Okay, so what they wanted to do was they wanted equipment instead of paying the cost for this contractor to do it. So it's costing them almost 20 grand a month to pay a company to do it. What they want to do is just get a machine and do it for themselves. Okay, makes sense. So a lease ended up running about $1,000 a month for them. That's not bad, okay? I mean, they got a de-stumper. It cost them about $1,000 a month for the equipment. Okay, now the business owner saved 19 grand a month because ultimately they got a $1,000 lease for a piece of equipment that replaced the people they were paying 20 grand a month to do the same job. So I ask you, what was the rate? Well, the rate was high. It was really high. In this guy's case, the guy who qualified was very high risk. I mean, we barely got him done. The guy tried several places, couldn't get equipment financing done anywhere else. The guy only qualified for a high-risk equipment loan, not equipment lease back, not our low equipment lease products. The APR was almost 60% for this guy. I mean, that's how it worked out, was because of the risk of the transaction. It was almost 60% this guy's APR was. Yikes, right? 60% APR. Okay, but he saved $19,000 a month. And all the interest he was paying was 100% tax write-off. So what was the rate? It doesn't matter. You see, in this case, if we would talk to this guy and say, look, equipment financing might work. What's my rate? 60% APR probably because of your risk. That probably would have ended the conversation, right? But when we do the math, we get the guy approved, we save him $19,000 a month and show him the whole equation and say, look, we got you approved. These people all denied you. This place approved you, but here's the rate. It's high. Here's the APR. It's high, but I think it still makes sense. Look at how much you're saving. Guess what? The client's all about it. The client says, oh my God, this is amazing. I mean, saving almost $19,000 a month, got to pay some people to do this, but even when I pay the people to run the machine, I'm still going to save $16,000, $17,000 a month. And the interest that I am paying, because of my risk, I'm getting all that back as a tax write-off at the end of the year anyway, so I really didn't pay any interest because it's a 100% tax write-off. So does this deal make sense? Of course it made sense. The guy kissed us on both cheeks. The whole year, every time he made that $1,000 payment with that 60% APR, he loved it. Why? Because the interest rate didn't matter. It really doesn't matter. What matters is, does the deal make sense? Okay, did it make sense to the client? Saving $19,000 a month for this guy made a lot of sense. Okay, so the guy said, I'm all about it, even because of the rate dealing with the risk. Okay. Over 90% of our programs, and this is really what your answer should be. Now that I went through that, and I wanted to go through it because I wanted to show you, first of all, rate really doesn't matter. And I wanted to show you on a personal level to me and my old experience, and on a level now with business owners, on how if the person only looked at the rate, they would be looking at the wrong part of what really matters. What really matters is, does this make sense for you? Does it make sense for you as a business owner? Do you save the money? You know, and because of that, you don't want to get bit by this loaded question that the client's asking you that even they don't know what a good answer is supposed to be. So how do you answer the question, what are the rates on the programs? Here's your exact answer. Write it down. Type it. Whatever you need to do. Come back to this webinar because this is it. Mr. Customer, over 90% of our programs aren't offered through conventional banks, and most aren't based on standard interest rates. Okay, that's the right answer, right? That's the answer we want to tell the client because that's the answer that's actually factual true. Mr. Client, you're asking what the interest rate is on our programs when 90% of our programs aren't even based on standard interest. Now, what I like about this part of the answer is that you tell the client, hey, 90% of what we offer, you can't even get at a bank. So that's an impressive answer, beginning to the answer anyways, because wow, 90% of what you offer can't even get through a bank. Yeah, and because of that, a lot of it's not based on standard interest rates. Okay, but that's not good enough. Somebody wants to hear something more. So let's tell them what they want to hear. Because they're asking you a loaded question of which they don't really know the answer. They're going to try to take whatever rate you rattle off and try to assess whether it's a good or a bad rate based on data they don't even know, right? I mean, it's so funny if you think about it. What's the rate? What's the rate on that equipment lease? Well, sir, what do you think rates are on equipment leases? I don't know. Well, it's 6%. That's too high. So what you ultimately want to do is give the person, you gave them the right answer. Now you want to give them the answer they want to hear. Well, Mr. Customer, the programs that are based on interest start at 0% intro rates and then 5% or higher after that based on risk. What we're talking about here is unsecured credit. Okay, the only two real kind of programs based on interest through the finance suite are unsecured credit and SBA loans. We're going to talk about SBA loans here in a minute. Okay, so, well, 0% interest rate, intro rates. Now we're talking about unsecured credit. That's based on interest, and that stuff, like SBA loans, goes to 5% and up beyond that, based on risk. Okay, so that is exactly what you're going to say so far. What's the interest rate on this program? Mr. Customer, over 90% of our programs aren't offered through conventional banks, and most aren't based on standard interest rates. The ones that are start at 0% interest rates or so, and then 5% or higher after that based on risk. Why I added this is now you told them what they wanted. They needed a number to put in their head. We gave them a number, 0 to 5. Okay, there you go. So now you tell them what's actually, look, this is what's really going on. 90% of our stuff's not based on interest. The stuff that is based on interest, it starts with usually low intro rates and has about a rate of 5% or more after that, because that's the stuff that we do have is based on interest is based on. But, Mr. Customer, most other programs are based on other things such as factors or discounts. That's the best answer. You hit it all. Mr. Customer, over 90% of our programs aren't offered through conventional banks, and most aren't based on standard interest rates, okay? But the ones that are start at, 0% intro rates, and then a lot of them jump to 5% or higher after that based on risk. And again, most of the other programs we have, they're really based on other factors other things such as factors or discounts. That's the best answer because you told the customer most of our programs aren't based on interest. The ones that are based on interest are based on this, okay? And again, the other programs are based on other factors such as factors and discounts. So now you really gave the client the 100% sincere, truly factual, accurate answer, okay? And at the same time, you kind of gave them something they wanted to hear anyways, which is an interest rate. They just wanted to stuff something in their head, and you gave them a good one to stuff in their head of 0 to 5%, which is very, very, very accurate reflective risk of where our unsecured and where our SBA programs start. Okay, keep in mind how lending risk and charges work, ladies and gentlemen. You can't take somebody, and I see people do this. They try to take terms on merchant advances and compare them to bank loans. We all understand that they're not the same, right? I mean, we all understand that a merchant advance, they're asking for merchant statements, and, for an SBA loan, or a bank loan, they're asking for a lot more. The risk is higher, and this is just risk. This is a risk scale. It's as simple as that. Merchant advances are the most expensive money you're going to get. They're a cash advance. Okay, on the consumer world, a cash advance is the most expensive money you're going to get, period. Cash advances are the most expensive money you're going to get. Merchant cash advances are the most expensive in the business world. The same as personal cash advances are the same in the consumer world. Okay, then you go down to like revenue lending, equipment financing, then you get down to SBA loans, then you get down to actual bank loans. So this is kind of the scale here. Now again, you got to be careful with that loaded question because somebody comes in and asks, what's the rate? They're talking about down here. This is all they've been familiar to. Most of them have never even heard of these type of things before. Okay, but again, lending is based on risk, and there's no question these other higher programs are going to have higher risk, which is why today we're going to be talking about the SBA and the actual lower interest rate programs. Okay, so that being said, let's move on to the actual SBA secured programs. Look, SBA is with us the lowest feed program you're going to get because it's the lowest risk. It's full doc. Now, what you're going to see here today is pretty similar to what a bank offers, okay? Now, you saw on that scale before this that, SBA loans are right above bank loans. Well, the problem is nowadays most banks don't do bank loans, right? They don't want to take on the risk. Because of everything that's changed in the economy, a lot of them, they're not filling their portfolio. They're not using their own money. They're not buying loans. What they're doing is using the SBA. They'll only do loans that the SBA basically insures. Okay, they want that SBA guarantee. And if they have an SBA guarantee, they'll do the loan. If they don't have a loan that can be guaranteed by SBA, a lot of lenders aren't going to lend a lot of money. We all pretty much know that. I'm taking a drink of water, which is the reason for the pause. So that being said, SBA loans that you're going to see here that we have are very, very similar to what a person's going to get at a conventional bank. And this is why I think it's important, because a lot of people come in and go, well, they think they can get this at their bank, or they said they can get this at their bank. No, they can't. They can't get that at their bank. Today we're going to talk about what's required for an SBA loan, how these things work. So you know what a person can go into a bank and get. When they go to a bank, they're typically getting SBA, and this is what they're going to basically be able to get. This is the qualifications they're going to have, the income docs, those type of things they're going to look at. So SBA secured programs are perfect loans for businesses looking to expand or for the purchase of a new business. Okay, so established businesses with good revenues and profit that can be verified by tax returns, can get very large amounts of funding. Now, I always think this is funny because everybody thinks their business is unique here. Okay, I was talking to a business owner with a client the other day, and he said, what do you want? I want a $150,000 credit line. And I asked him the questions, and he was going to get a $50,000 credit line probably, not $150,000. And, what did your bank give you? 20. Okay, well, let me ask you this. If you want to get a $250,000 credit line, you need to show tax returns with high net profits. And he proceeds for the next 15 minutes to basically tell me a story about how his business is growing and how because of that, on his tax returns don't reflect high net profits. Ladies and gentlemen, guess what? I get it. We're all the same. All business owners are the same. Okay, very few business owners show high net profits. They try to write off as much as they can to pay as little taxes as they can. Okay, that's not being dumb. That's being pretty smart, and that's having pretty good accountants to do so. The problem is when you go to get business financing, it matters. Okay, and this guy could talk to me for an hour about, well, it's this and this. But look, we all understand. We all have the same equation. Everybody tries to write off what they can, and as a result, the net profit is low. Well, established businesses with good net profit on their tax returns are good candidates for SBA financing. But the problem right here is most people don't meet this criteria. Okay, yeah, they have good profits, but with all the write-offs and everything, when their taxes are done, they reflect a very small net profit, and that's what's needed for a lot of SBA. Okay, so our programs, we really specialize in funding programs for SBA that range from $200,000 to $12 million. Okay, loans guaranteed by SBA. Loans are guaranteed by the SBA. That's what SBA does, okay? And you're going to learn a little bit more about that in a minute. But basically, SBA is guaranteeing that if that loan defaults, they're going to absorb a certain percentage of the risk. It's guaranteed by them, meaning, again, if it defaults, they'll pay the lender back for a certain portion of that actual loan, of whatever they guaranteed. So SBA 7 loans. We're going to talk about these, but I want to you at least see some good industries these might fit for. Franchise purchases, business acquisitions, working capital for growth, inventory expansion, partner buyouts, opening additional locations, renters now wanting to purchase real estate, build-outs, renovations. Those are common things that one of the type of SBA loans, an SBA 7 loan, is commonly used for. And again, we're going to dive a little bit more into this in just a minute. Okay, that's awesome. My headline populated second. Okay, so secured SBA loans. Loans up to $12 million. Interest rates are typically prime plus 2 to 2.75%. Prime right now, I don't know, is maybe 3.25%. Last time I checked. It's a habit that I check prime rate for my mortgage days, and last time I checked Monday, I think it was 3.25. So right now it would be 6%. Would be an SBA loan. It's typically about 2 to 2.75% over prime rate. Prime right now varies. Prime is 3.25 right now. Closing costs can be financed. Okay, 10 to 25-year loan periods. Interesting stuff here. Closing costs can be financed. Well, so can they with our unsecured credit, right? You know, everybody freaks out about that 9% fee being rolled in, but SBA loans are no different. There's a fee assessed and the fee is financed into the deal. Okay, this is a big difference. From almost all other kind of financing, SBA by far offers the longest terms. You're going to see with revenue lending, with merchant advances, this kind of financing is 6 to 18-month terms. So with SBA, you're talking 10 to 25-year terms. You're talking very long terms, which allow for large amounts of money to be financed at lower payments. Mostly not as much because of the interest rate, but because the term is so long. Okay, and they're going to charge a fee of 1 to 2 points. Okay, so again, think about this. For our unsecured credit, for example, you're talking about somebody paying about a 9% success-based fee. Even with everything that's required to qualify for SBA, they're still going to probably pay 2 points that are rolled into the deal anyway. Now, these are for-profit only companies. They have to have collateral 50% of the loan amount. The collateral can be cash, stocks, bonds, business assets, equity, and real estate. Okay, again, something interesting to point out. With the finance suite, we look at somebody that just has any kind of collateral or strength. Let's say their collateral is their credit card sales, and they can get money only based on that collateral. With SBA, they still have to have collateral to qualify. As a matter of fact, the collateral has to equate to 50% of what they're actually borrowing. Okay, they've got to have positive trends in sales growth, which means they can't be dipping down. You know, they need to be making more money every year, not less. No bankruptcies in the last 4 years either. $200 to $5 million loan amounts are available through SBA 7A programs. Very interesting. You've heard me before mention certain programs that go to $5 million and certain programs that go to 12. Then you've heard me mention the SBA programs go to 12. Which is it, Ty? It's both. SBA 7 goes from 200 to 5 million, okay, while as 504 SBA loans go from $500,000 to 12 million available through the SBA 504. And you're going to learn about the SBA 7 and the SBA 504 here in just a minute. We're going to go through both these programs. Okay, as has a 90% loan to value. Okay, another benefit of why people like SBA, the loan to value is so high. Closing costs can be financed. Typically, no balloon payments are due in the end. Okay, some loans can be assumed by a future buyer, and longer loan periods mean lower monthly payments, which we just talked about. Okay, so this is for-profit business only, which means no investors. Okay, they need to be open for 2 years. Why? Because they're asking for financials. It needs to be an owner-occupied business for real estate transactions. If they're buying real estate, it can't be for investment. It's got to be for owner-occupied. Okay, everybody that has over 20% is going to have a personal guarantee. Again, interesting. We've got a lot of finance programs available through the finance suite with no personal guarantee, ladies and gentlemen. So yeah, the risk is higher and the terms are worse than SBA. But look at some of these things with SBA. Every SBA loan, everybody that owns more than 20% has to come as a guarantee. We got a lot of financing that's available initially in step 2 for the client where there is no guarantee. Our purpose is to build business credit for the client so they can get money with no guarantee. So I'm pointing this stuff out because think about this. No bank does this. A bank offers this SBA loan that's this and nothing else. Our programs, we can get them money based on only their strengths. We can get them money without a personal guarantee. Whereas SBA it's very strict on its standards. They need a 620 minimum FICO to qualify. Another very interesting thing. Even if you have a business that's been open for years, successful financials, they still need average credit or higher to qualify. We've got a lot of programs through the finance suite that they can get bad credit for. Doesn't mean the terms are worse, obviously, but they're not going to get money through their bank. It's not going to happen. They need a 620 or more, and 620 is bare minimum. These deals are hard to get done. Usually, it's going to be higher than 620, okay? Most people on this call know how hard it is to get approved for the unsecured credit cards. Their guideline says 580 to get approved credit score, right? So SBA's credit score is 620, but they're looking at a pretty good credit profile, so just keep that in mind. And the cash flow must be 1.2 plus the debt cover rate ratio, which should say debt cover rate ratio, which is the profit after depreciation divided by their loan payments. Okay, their cash flow needs to exceed 1.2 factor of that debt cover ratio. And again, what that means is the profit after depreciation divided by the loan payments. The cash flow for that business should exceed 1.2 of that ratio. Okay, owners, personal income covers personal debt. It must be as a requirement. That means they cannot be getting a loan and they need the business to cover their personal debts. They're going to need to reflect that whatever income they get can cover their personal debts. They need to show positive trends in sales growth, and sales growth projections are okay in 7A loans. You're going to learn why in a minute. When you learn what 7A loans are, you'll understand and learn why projections are acceptable for 7As, but by the other SBA loans need actual financials. No bankruptcies in the last 4 years. Collateral could be home equity, cash, stocks, bonds, equity in real estate. Again, has to be 50% of the loan amount. Okay, SBA is a U.S. government agency formed to help small businesses. Okay, there are two programs, the 7A and the 504. SBA guarantees against losses. Okay, so securitization of loans by the borrowers combined with the government guarantee results in higher loan to values and lower rates than normal. Allows business owners to preserve more capital for uses and gain the highest ROI. Okay, so let me talk about this in mortgage terms. Maybe because it's easy for everybody to understand. It's definitely easier for me because I come from that industry. You know, if you're talking about with kind of the same thing with a mortgage. I'm trying to find the best way to explain this. When you go to buy a mortgage, it always used to be that you needed to put down a 20% down payment. That's the way it was. You had to put down 20%. Then there were companies that came around that were called PMI, private mortgage insurance. They insured the 20% default. So what happens is a bank lends you the money, and the bank has a PMI company guarantee them that if you do default on the loan, that PMI company will pay that 20%. So they'll pay it. So they're saying, look, Mr. Bank, you give them the 80%, we'll insure the other 20%. If the person defaults, we'll give you that money for the 20%. It's exactly the same thing with SBA. Okay, what's ultimately happening is the borrowers are taking on part of the responsibility. They're going to be responsible. Okay, if the loan defaults, the bank would go to SBA to cover part of the default, the borrower to cover part of the default, and because the SBA is involved absorbing part of that risk, the bank isn't taking on all of the risk. Okay, so SBA 7 and 504, longer terms are typically versus other bank financing. Okay, allows for smaller monthly payments. We know that. No balloon payments. Programs are fully funded by fees charged on loans. Okay, no big deal. Both programs are only for owner-occupied businesses. We're repeating some of the same content. Okay, any existing or potential small business is a target or for possible SBA. Okay, the sky's the limit for these programs. Okay, these loans are essentially the only source of major lending for new franchises and other startups. We're talking about SBA 7 loans here. Okay, pay attention, because these loans have very specific purposes. So SBA 7 loans, any existing or potential small business is a target for these kind of loans. They're essentially for a source of major lending for new franchises and startups. Okay, they can be used for partner buyouts, to buy out a partner. Okay, you can get up to SBA loans are up to 70% of all loans currently closing. Interesting. Okay, over 70% of all loans closing are SBA 7 loans. Let that sink in. Okay, so that's a pretty big deal. So these are pretty common loans. Of the actual loans that do get done, SBA 7 are by far the most common. And this is for businesses that are just renting, or ownership provides stability of rent, depreciation and write-offs not available to renters. Okay, so this is basically for businesses, for example, that are renting, and ownership provides the stability of the rent. The depreciation and write-offs are not available to the renters. Okay, so for profit businesses with at least 2 years of history that need funds for expansion, acquiring another business, or managing cash flow. Okay, again, very specific purposes for these loans. So SBA 7 is really mostly used for expansion and acquiring another business. and sometimes buying out a business partner. But that's usually what those funds are actually used for. Okay, now at closing, roughly 2.25% of the loan amount is collected as a one-time fee to the SBA, okay, not a lender. Okay, so again, people think these fees just come from the person that they're talking to that sells them the product, and it's just not the case. Okay, with SBA, there's a 2.25% fee that's collected and rolled into the loan, so the client doesn't even feel it. Okay, so think about that. You're already on this one product, already looking at another 2.25%. Now you've got a point origination fee, which is pretty standard from the bank. Okay, so again, I compare this to our unsecured because you're talking about with unsecured, somebody's getting $50, $100, $150,000, no doc, no questions asked, and they're paying a 9% success-based fee. With these, even with an SBA program where they're providing everything to qualify, they're still looking at least the 3.25%, 4% fee or more. I mean, the fees are still up there, and since these loan amounts are high, it's a massive amount of money that usually gets rolled in depending on how high that loan amount is. Now, what happens is SBA guarantees 75% of the losses with this loan should the loan go bad. Okay, so the bank exposure is only 25%. You get why banks aren't lending now? There you go. Why? You know, why take on 100% of the risk and lend a business money when you have SBA that's going to absorb 75% of the risk for you? And if you do this, then you could do more SBA deals than bank deals because guess what? SBA is absorbing 75% of the risk. This is why just about almost every bank is mostly dealing with SBA paper and nothing else because SBA is absorbing so much of the risk. Okay, the only problem is they're paying SBA, they're paying the bank, so it's no different than with us. If they're going through our sources, it's pretty much the exact same pricing as they're actually going to experience with the bank. And because of the above, lenders are willing to lend up to 90% on the program because, again, SBA absorbs so much of the risk. So SBA 7 includes bank lending to businesses with no real estate and even startup franchises. Pretty important. You're going to learn why because the other SBA program deals with real estate. With SBA 7, you're talking about businesses with no real estate, even startups. That's why you just mentioned we just talked about rent and depreciation. Okay, because with SBA 7, some of these people don't own the property. They're renting the property. They might even be a startup or actual franchise. So overall, banks are more willing to lend under this program. Only program that allows projections, they will be scrutinized heavily, of course, okay? Because because of this, because it's got no real estate, because it might be a newer business, they might accept actual projections instead of years and years of tax returns. But of course, those projections would be ridiculously scrutinized. Okay, and gifts for down payment are okay for SBA programs. Okay, so for the SBA 7, the loan value can go up to 90% on real estate only deals, 80% on other uses, okay? So if it is a real estate only deal and the place owns real estate, they'll go up to 90%. Okay, if it's for other uses and they're not owning it for real estate, then they go for 80%. And then here's the amortization, okay, 10 years. And I mentioned before, I think I said something about the SBA 7 not being for specific real estate, and that's going to make a little bit more sense when we jump into the 504, because again, you'll see the specific purposes that the 504 is for where the 7A isn't. Okay, so 10 years on working capital. If they're getting money for working capital, they're going to get a term of about 10 years. About 25 years on real estate would be the term. And about 10 years on if they're getting a business only, if they're buying a business, equipment, those type of things. And again, rate is almost always adjustable, tied to prime, plus 2.7. So it's about 6% currently based on current prime rate. All others are prime plus 2 to 3.25. You know, again, the rate currently is about 6% on that kind of loan. Loan amounts from $200 to $5 million. Remember, okay, only to $5 million, not to 12 on the on the 7A programs. 620 FICOs. Okay, but 660 or higher is more likely to get approved. Remember I just told you that? I said, okay, 620 is the minimum, but they're obviously going to look at a better credit profile to typically approve them. Now you're learning that. Okay, your typical 620 score isn't going to get an SBA loan. It's typically going to be a 660, 680 credit score, even though the guidelines say they go as low as 620. Okay, the business must cash flow. We already talked about that. Borrower must cash flow. Okay, and again, we talked about that. They've got to cover their personal expenses with their income. Okay, positive trends in sales growth. So the business that dipped in 08 and 09 grew in 2010, 2011, for example, would be okay. Okay, so businesses that maybe dipped because the economy was bad and then they're picking back up and now their sales are increasing, that's okay. They just need to be in the middle of a positive cycle. Okay, meaning that, you're going to talk to business owners that, in 2011 they made 100 grand. In 2012 they made 70. That's a problem. If their income and revenue is decreasing and it's recent, that's a problem. No bankruptcies allowed in the last 4 years. Many lenders will not allow at all, regardless of time passed, okay? I just think this is so interesting because as we look at the requirements for so many of these other programs, we see they also apply. So even these SBA programs, which have these really, are supposed to be these fantastic terms, the terms aren't that far off radically from the high-risk programs, and a lot of them have similar fundamental requirements like this. You can't have a bankruptcy in the last 4 years, but any bankruptcy could really be a problem for people even applying for SBA loans. Refinancing existing SBA loans, generally not allowed, but very, very, very rare exceptions do exist. Okay, so collateral is in the form of, we went over that, equity, home, cash in home. Most banks will want 50% or more collateral. We talked about that in general for SBA. That does apply for the SBA 7 programs. Many options are available. Some, and this is interesting, some lenders emphasize experience. They want to see, the business owner's been around a while, the business has been around, the business has experience. Others emphasize collateral. They'll make the decision more based on the type of collateral you have versus the actual experience of the business. 10 to 25% down, we talked about that and how it was broke down. And lenders may require a second or third lien at the borrower's primary residence if equity is available to support collateral requirements. Okay, so that means if the person needs to provide collateral, maybe the collateral is in their private home. Okay, SBA will even come in as a second or third lien on their private home using that home as collateral. But remember, they need collateral 50% or more of what they're borrowing, okay, even if they have to use the personal home for that collateral. This is funny. I mean, if you think about it, right? The whole purpose of us building business credit is to eliminate the person's liability. We offer this financing where they can get money with no personal guarantee, and now here they are with SBA having to front their personal residence for their guarantee almost as collateral. I mean, that's a big deal. And it's not saying that they have to front that, but saying it could be used that if that's the only collateral they have, for example. Okay, so now let's talk about 504 programs. These are specifically for the purchasing of real estate for owner-occupied businesses. Okay, these include renovations, equipment, ground-up construction. Cash out is not allowed on these programs. Okay, working capital, including inventory, is not available. Interesting, right? So you're starting to see the separation. The 7A, you could get working capital. You could get inventory, not through a 504. Okay, the benefit is fixed rates as low as in the current 5s. It's actually about 6%. Again, pretty much the same equivalent, which we're going to learn about 2 to 2.25, 2 3/4 plus prime rate. Okay, real estate purchase expansion, also used for real estate construction, real estate refinance, major equipment purchase. So it's almost all real estate for your 504 except for some major equipment. Okay, for-profit business only. Now, again, it might sound like I'm repeating some of the information, but it's because we talked about SBA loans in general, and now we're talking about some specific requirements for each, the 504 and the 7A. So this is for-profit business only with at least 2 years of tax history, and they actually want a little bit longer if they can get it. The term is fixed or adjusted, a term fixed or adjustable rate loan to purchase, expand or construct owner-occupied real estate, or purchase major long-term equipment. Again, that is the purpose. For applicable real estate and equipment, generally or purchase only, no business-only loans. Generally, these loans are not for startups. Very few get done. Okay, so unlike 7As, 504s really aren't for startups. These are really mostly for people that, have or getting real estate. Refinances on 504 programs are one of the newest developments. Okay, provisions exist for assumable mortgages, but they can be exhumed, and loan amounts are up to $12 million. Again, interesting. 7As go to $5 million. These loans go to 12. Bank holds the first mortgage on real estate or first secured interest in machinery and equipment. The SBA holds the second mortgage on the real estate or second secured interest on the real estate. Okay, and $500 minimum loan amount here. okay, on the 504. SBA allows financing up to 90% loan to value on this program. The bank provides the first mortgage up to 50% loan to value. SBA places a second mortgage up to 40% loan to value. 10% must come from the borrower's seasoned funds. So they must have funds, they must be seasoned, and they must have at least 10% of their own funds into the equation. Okay, FICO score as at least I'd put similar to 7A, is at least a 620. Businesses must cash flow the same as the 7A, 1.2 debt coverage ratio, okay, which we already went over that on the 7A. Borrower must cash flow on their own personal debt, which means they must make enough income to basically cover their personal debt. And again, positive trends in sales growth. Okay, generally no projections are allowed here unless the business cash flows in current year, focuses historical cash flow and actual trend. So unlike the 7A, no real projections here on the 504. No BKs in the last 5 years, and again, a lot of lenders is going to be tough to get approved regardless of how much time has passed. The down payment typically is 10% that's needed on a 504. Special use properties like hotels will require an additional 5 to 10% fee, and again, you're talking about that same points, 1 to 2 points are charged on the first mortgage. And again, these are typically higher amounts. It's not the second mortgage. You are paying money on the larger loan, which is the first mortgage. Okay, so what we just did there was we went through the two types of SBA loans. And I now hope that you have a pretty good understanding of both, the SBA 7, the SBA 504. Of course, this webinar is going to be available for playback, and of course, you might need to go through it a couple different times. But once you get a pretty good general idea, for example, that a 7A can be used for many purposes, including cash flow or including just general business purposes, and loans like 504 are basically only for real estate, heavy equipment, you'll get a pretty, and most of what we covered, you'll see it's pretty similar for both SBA loans. Okay, but now you get a good idea of how SBA loans work, what they are, how they're insured, how they're guaranteed by SBA, the risk the lender takes. You've learned about the terms. You've learned that the going rate on these is about, 2 3/4% above prime, which is about 6% plus. Okay. You've also realized that the fees on these include about 2.2% fee in some cases with SBA, 2.25%, plus upwards of 1 to 2 points. So a client can even pay 3, 4, 5% in fees with SBA loans, as you've already seen. Okay. And you've also learned that some of the requirements, even for the unsecured credit, are the same here. The person needs pretty good credit. They need to have collateral 50% of the loan amount. In a lot of cases, they need pretty strong financials for years. Okay, so they need to come in with the full documentation loan, all those things to qualify. And in the end, they're getting about a 6% loan, okay, with, about 3, 4, 5% in fees. But don't get me wrong, don't go, well, Ty, this guy was quoted 5.25%. I'm giving you an up to range, okay? Like I said, it might be 2 to 2 3/4% over prime. So if it was 2, that would only be 5.25% rate. So it's based on risk, but it could be as high as 6%. And again, the going rate they're going to get at a bank is pretty similar to what they're going to see through us. Okay, so now what I want to show you is what it takes to get approved, what the qualifications are for SBA, okay? What's the difference? Why I think this is important, for one, is especially on our unsecured credit. A lot of people on the unsecured credit come in and say, well, we say, look, I don't want to pay the 9% success-based fee. Fine, go full doc. What you're going to learn now is what full doc is. Okay, we have a credit line that goes up to $250,000, our enterprise cash line, okay? And it's very similar to the requirements you just have seen so far here. And this is pretty much the requirements to get approved. The reason we don't really talk about it to clients a lot is because most clients don't qualify. But this is important because the finance officers are going to start talking to your clients about full doc. They're going to start telling them the requirements. They're going to probably submit a packet to your clients of 5 to 10 pages of the requirements for full doc, and giving the client the choice, letting the client choose to go no doc versus full doc. Because ultimately, I use the unsecured as an example because, look, the unsecured credit pays 9% or 9-point success-based fee. You could go full doc and pay 1 point. Okay, so everybody would rather pay 1 versus 9, but do you really want to go full doc? That's the question. And that's a question that clients will have to answer. And what you're going to see now is what full doc really is. So to qualify for an SBA loan, the first thing a client's typically going to need is the SBA loan application. And this is exactly what the SBA loan application looks like. Okay, here's the first page, here's the second page. Pretty basic stuff. Business name, address, number of employees, time and location, inventory, acquisition, construction, what are they getting money for, what do they want to use it for, current and previous SBA and other government debt that they have, business indebtedness. They want to know all about the business debts. They want to know all about all partners, race, address, social security number, percentage owned, are they veterans, their gender. This is stuff they don't need to know, just little disclosures they put on the application. You're going to ask a bunch of these questions. Do you have any officer ever been involved in a BK? Anybody in pending lawsuits? Any spouse or anyone who owns, manages, or directs a business, household that works for, I want to know if somebody works for the SBA. Does the business owners, does your business, its owners are the majority of stockholders, or there are other investors, and so on and so on and so on. So there's a bunch of questions they're going to ask the actual business owner. And then there's certifications that the client's going to have to certify too, and some special things they're going to fill out if it's a construction or an export loan, whatever kind of loan it is. And then, of course, they're just going to certify it's accurate. They're going to sign it. Okay, the SBA is also going to want background. And just so you know, everything I'm showing you here for the rest of this webinar comes from SBA's website. I copied and pasted it. I don't want you to think this is my content. When I'm going through the actual list of items that they need, the description of the items, the applications, I just actually went to SBA's website, got it all, and put it here. So when it says fill out this application, I went and got the application so we could see what it actually looked like, because I think we all need to see what a full actual underwriting process with SBA really is. Okay, they're going to need either as part of the loan application or as a separate document. They're going to be asked to provide information with a personal background, including previous addresses, names used, criminal record, educational background, and etc. Okay, this is the statement of personal history that they're going to be actually asked to fill out with all that kind of information on here, okay, from SBA. They're also going to be asked to fill out a personal financial statement, cash on hand, IRAs, stocks, life insurance, real estate, automobiles, personal property, life insurance, accounts payable, source of income, investments, salary, real estate income, are they co-signers on debt, those type of things. Notes payable to banks. They're going to want to know all the stocks and bonds, all the real estate properties that they own, purchase dates, original cost, market value, balances, all those type of things. They're going to know about any other personal property. They're going to want to know about unpaid taxes, other liabilities. They're going to want to see if the person has life insurance details on that. They're also going to want resumes. Some lenders require evidence of management or business experience, particularly for loans that are intended to be used or intended for a new startup business. They're going to want business plans. They require a sound business plan. The business plan should include a complete set of projected financial statements, including profit and loss, cash flow, and balance sheet. They're going to need a personal credit report. Okay, the lender's going to pull that as part of the application. The person is going to need to have a report from all three major reporting agencies before submitting the loan. Inaccuracies or blemishes on the credit report can hurt the chances of getting a loan approved. It's critical to try to clear those up before they apply. Again, this isn't coming from me. This is from SBA's website, their exact wording. This is copied and pasted. So let's look at it again. Your lender will obtain a personal credit report. Inaccuracies, blemishes on your credit report can hurt your chances of getting a loan approved. It's critical to try to clear these up before beginning the application process. I read that again because it shows all of us some insight into SBA's brain of what they're looking for here, okay? Yeah, they say 620 scores, but they're telling you right there, if you have any blemishes, it's going to hurt your chances of getting approved. They're clearly stating that. Okay, you're going to need a business credit report. If you're already in business, you need a business credit report. As in with the personal credit report, it's important to review the report, make sure that it's accurate before applying. They're going to need tax returns for the last 3 years. 2 to 3 years is typically requested. They're going to need to provide a brief history of the business and its challenges. They're going to have to include an explanation of why the SBA loan is needed and how it will help the business. They're going to need to include a copy of their business lease or a note from their landlord. If they're purchasing an existing balance or an existing business, they'll need a balance sheet, P&L. They're going to need 2 years of tax returns, proposed bill of sale, asking price with schedule of inventory, machinery, equipment, furnishing, and so on. They're going to, for all SBA loans, they're going to need financial statements. Anybody that more than 20% stake in the business is going to have that. They may also be required to provide projected financial statements for the business, and it's a good idea to have those prepared and ready when the lender's asking for them. Business financial statement to support the application and demonstrate their ability to repay the loan. Prepare and include in the following statements. They're going to need a P&L statement for the last 90 days. They're going to need projected financial statements, including a detailed one-year projection of income and finances attached, a written explanation to us how you expect to achieve this projection, and so on. Bank statements, they're going to need personal and business bank statements. It doesn't say how long. It's typically a year that they want those. They're going to need legal documents here too. Depending on the loan's specific requirements, the lender may require things, certain legal documents, so make sure they have any legal documents that are needed: business licenses, registrations, articles of incorporation, copies of contracts with third parties, franchise agreements, commercial leases, all those things the SBA is going to want to see. Ownership and affiliate, and include a list of names and addresses of any subsidiaries and affiliates, all affiliates, including concerns in which you hold a controlling interest, and other concerns that may be affiliated by stock ownership, franchise, proposed merger, or otherwise with you. Your original business license or certificate of doing business will be needed. If the business is a corporation, the corporation seal needs to be stamped on that. Which means they need to get that corporation kit, and with the corporation kit there's a stamp, so if they haven't bought that, they're going to need to buy that. And include record of any loans they may have applied for in the past is their loan application history. They're going to need collateral. Collateral requirements vary greatly. Loans involving high risk for default require more collateral. Strong business plans and financial statements can help avoiding putting up as much collateral. In any case, it's a good idea to prepare a collateral document that describes cost value of personal or business collateral that we use to secure the loan. And questions the SBA lender is going to ask. Why are you applying for the loan? How will the loan proceeds be used? What assets needed to purchase? And who are the suppliers? What other business debt do you have, and who are your creditors, and who are the members of your management team? Take a sigh and a deep breath. That's all from SBA's website, ladies and gentlemen, and if you have all those things together, you can qualify for an SBA loan. Now you see why so few people apply and qualify for SBA loans through us, okay? With all of the income documentation that's required, the forms that have to be filled out, the client hates us when they're even done with the first round. And then when the lender starts to ask for more and more and more documentation, they hate even more. But let me explain the real problem of what SBA loans, the real big problem. The problem is all of this documentation takes so much time that this is a 4 to 6 month process in a lot of cases. And what we found with clients is they don't want to wait. They get all this documentation together, and then the last thing they want to do is have done all this work for just one lender, right? And they have all this documentation already together, right? So, hey, they might as well as apply somewhere else and apply somewhere else. And that's the problem, is in a lot of cases, by the time the lender approves the deal, they already went and applied 9 other places. And now because of those inquiries and everything else, you went through all this work to get the deal done, and the deal doesn't get done because the person's applying everywhere else. So that's one of the fundamental problems with SBA loans. But the biggest issue is just what you just saw. It's the amount of income documentation and supporting documentation they require. But now you know. Now you know we have the loans, you know the terms, and most importantly, you know what full documentation is. So when a client comes in, for example, with unsecured, and they're given an option of going full doc and no doc, and paying 9% versus paying 6% or paying an interest rate of 5% or higher versus paying a 6% interest rate anyways, and paying a 9% success-based fee versus a 4 or 5 success-based fee, ladies and gentlemen, all of a sudden it just seems to make a lot more sense to go with some other products versus SBA because of the massive headaches SBA causes, and because, let's be honest, the terms aren't that great. I mean, if every person's paying 3 to 5 points for every deal, and they're getting an interest rate of 6%, that's not significantly better than a lot of the financing programs we have. So just things you want to keep in mind as you're actually talking to people about the SBA programs. There's a lot involved with getting them approved. A radically small percentage ever do get approved, and in large part it's because so much documentation is being requested. There's typically something wrong with the business throughout all this documentation that the lender or SBA doesn't like. Remember, you got to qualify with SBA and the lender, and that's why you just don't see a lot of these programs, although we do offer them. And it is great that we offer them because we do have the programs that can compete with the bank, but you also now see why so many of these banks are turning them down. You know, I mean, over 70% plus of applications that go through a bank are denied, and you now know why. I mean, it's much more than even 70%, but now you know why. I mean, there's so much that has to be looked at that these are very tough loans to qualify for. That being said, that's why we offer so much other financing. That's what makes the finance suite so successful, because we have so many other kinds of financing that don't look at any of this data, that only look at the strength of the business and get a business owner money quickly, 2-3 weeks quickly based on the strength of the business, versus putting them through a 4-month approval process where everything is required and 70% people get denied anyways, right? So again, one of the reasons, some of the benefits why the finance suite makes a lot of sense, and some other things I hope you got out of this webinar was understanding how difficult it is for a person to actually secure financing through a bank, which gives us such a huge advantage with the finance suite, because we can help so many of those people that banks just simply can't help because these people just don't meet these criteria. So hopefully you learned a lot about SBA. You learned a lot about the program, how to overcome the question or answer the question, what is the interest rate. Hopefully you got a lot out of this. I'm going to open it up to any questions, although I haven't seen any questions. So what I'm going to probably do is just wrap this up. We're at 4 o'clock. I'm going to wrap it up. If you have any questions, send me an email, ty@streetsuite.com. Give me a call, and I'll probably have this available for you for playback as soon as tomorrow. So you'll be able to go back in, play it, stop it, write down things, and jot down some more notes on the SBA program. So thank you very much for taking the time to attend the webinar. I hope you all have a fantastic week, and don't forget, it only takes 3 sales to get some really nice incentives with business credit this month, so I'm hoping that the majority of you can hit that level. Thanks, everybody. Have a great day.